All right, you ready?
I'm ready.
You can be, I guess.
Hey everybody, it's me, Zarina Harris. I'm here with my fellow LOI event members. We have Sabrina Allen.
Hello.
And we have the Revival Brothers, Sean and Joe.
Hey.
All right. We're going to talk about a very interesting topic today. We're going to talk about pricing. And the reason is because we're in a place in the market where we're sort of not where the gurus say we are. And a lot of people are coming into the industry. They're very excited because it's a really fun and exciting industry. And they're becoming really disappointed with either not winning bids or they just don't have realistic expectations of where we are as far as pricing. So we're going to sort of attack that today. We've got a few different topics to touch on with it. And the very first thing we're going to talk about is knocking over this first domino of the glitz and the glam that Sabrina had mentioned earlier is actually quite dangerous for newbies coming into the space. So do you want to speak on that a little bit, Sabrina, and then we can have Joe or Sean chime in on what they've seen recently at a conference.
So one of the things is the glitz and the glam is, you just can't believe the hype. I think that people get super excited. It's almost like those people coming into church on Sunday and becoming first-time believers almost. And they don't realize how hard it is to be good. They just don't realize how hard it is to behave yourself and be Christ-like.
It's only hard for you.
No, it's not. It's not. It's not hard for me. But it's almost the same thing. It's like, they see people playing church, and we see people playing with notes and playing with people's emotions and playing with people's financing, and they realize it's not what they thought it was going to be. I'm going to go back to an event that I was at last year, and there was a lady wanting to JV, and I was like, well, how much money do you have? She says, well, how much money are you willing to give me? I said, well, what do you mean? She says, well, I just spent my last money on my training. I said, so how old are you? She said she was 63 years old. She had depleted her savings into buying training and had no money saved, and she thought she was getting ready to become wealthy on notes. That's an example of somebody believing the hype and walking into the glitz and glam and not having a reality check that probably she'll end up getting cremated when she dies because she'll probably be broke.
Why don't we talk a little bit about where the industry is right now and the percentages that the sellers are asking for so that people know kind of where we're at versus what they're hearing with all the hype and glam.
So one of the things is like, we're seeing pricing all the way up to 80 some odd cents. I mean, and we buy pretty large. And
for non-performing, right?
And that's for non-performing assets. That is not for a performing asset. If I want to pay 80 cents on the dollar for a note, it's going to be performing. It is not going to be non-performing in any way, shape, or form. And the BPO in this is that notes are not real estate.
Right.
And that's the other mistake that people are making. Notes are not real estate. And before we actually came on as a group, Joe said something that was very, very interesting about location and other things that drive down the value of what you're paying 60 cents on. One of the things I just hit a seller with, I said, well, you sent me these notes in this particular area. I said, it is 42 sex offenders in the area. I'm not paying you what you want for it. And those are the things that now you have to get creative and think outside the box. If I'm going to deploy 65 cents to an asset on pricing, I have to think about what's going to affect my bottom line return when I try to sell this asset, even if I take it back as an REO.
So unfortunately, we had a technical glitch, and Joe said something really profound, and I'm going to see if I still have that recording, if I could insert it. But Joe, can you talk about a little bit what you were saying before, as far as what you're seeing and sort of the strategies and stuff that you have to adjust to because of the pricing? And you guys just came from a conference and seeing people come into the industry and not really having any idea of what prices are right now.
Right. So, our strategy when we first started is kind of similar to where we are now. And that is we're looking for non-performing notes that are vacant at the moment, simply because we want to be able to get in at a lower dollar amount take the property back and take it all the way through fix and flip. We're doing that, but we're also doing other strategies. I think you have to be diverse right now in investing in notes. So you can't just have one strategy. You gotta have multiple strategies and understand what kind of returns to expect on those strategies. So one example, we were talking about pricing, and pricing with some of these sellers is extremely high. Some of these sellers are asking for like 60 cents on the dollar, 80 cents on the dollar. I've seen it up to 100%. And their argument is, well, the value's there. This is what it's worth, and this is what the BPO came back with. We don't know where they got the BPO. We don't know how they achieved any of that. You got to do your own due diligence and figure out what the true value is. And one of the things I was saying is that the sellers don't dive too deep into the analysis of these assets. They just do surface level checks. In fact, some of them, all they do is look at Zillow, and Zillow is known to be high in value. So they'll take these values and then they'll say, okay, well, we're looking for 70 cents on the dollar for these. And then we'll take those same assets, we'll do our due diligence, and we'll understand that because of the location of those assets, because there might be some low-income housing or some other aspect of that might drive the values of those down, we'll do that due diligence, and we'll come back to the seller and we'll say, okay, well, we don't think that it's worth 70 cents because A, B, C, D, and then we'll make our argument. But if you don't make that argument, you'll never get the price down. And in some cases, they don't even care. They won't even lower the price because they know that somebody else is right behind you in line, ready to purchase some of these assets. So
some people are foolish enough to pay those high prices.
Right, and that was one of the things I was going to say, is that what's being taught out there is to make your bids based on percentages of UPB, which I don't think is right. I think you need to understand the return. You need to understand the value. There's a lot of things that go into it, especially when you're doing it as a business. And we can get into that a little bit later, but I didn't mean to interrupt you. Go ahead, Zarina.
So one of the other things is Zarina and I just looked at somebody getting rejected on a bid at 64 cents. Because the property was on the market for sale, because of this and because of that. Well, the property's been on the market for sale. There's no guarantee the property's going to sell. And they were actually having conversation based off of payoff, not even UPB. And I was just like, no.
Right.
I said, no, you can't increase your bid on this. So it's just ridiculous on the expectations. But I'll even go back a little bit to like 2014. When there was a Fannie bid that I was involved in at a very high level. And basically they thought that 69% of the portfolio would come back you could actually mod it. And because of that, their pricing was astronomical, around 76 to 82 cents of unpaid principal balance. I'm sorry?
And this is 2014.
And this was 2014 at a trade with Fannie that I was involved in. And it was early 2014. It wasn't even last quarter. This is first quarter 2014, where I had just finished a trade in 2013, and we paid about 28 to 36 cents on the dollar. So that was really, really hurtful to kind of look at those pricing, that type of pricing when you were looking to scale. When you were looking to scale your business.
So the reason I emphasized when Sabrina was talking about 2014 is because I ran the numbers for the 2018 and 2019 numbers so far at Fannie Mae. They're not at 70 cents anymore. Fannie Mae is selling non-performing assets to investors, to hedge funds, institutional people, for 88 to 98 cents on the dollar. So it's really not a space that you can, as an individual, even if you were a private equity firm and you gathered all the money together, it's not really a space that you can compete in. And one of the reasons that we're even talking about Fannie Mae is because we are very much in a trickle-down economy here in the note industry. We don't necessarily have a lot of players who play at the origin, like, they're the top source. We're sort of retail buyers. We kind of get what they don't want anymore, things like that. And if they are getting it at 80 cents, There's no way that you individually can expect to buy an asset from them where they're not going to make a profit and they're just going to cut this huge discount and let you have it for 50 cents or have it for 30 cents or have it for 40 cents. It doesn't make sense when they paid 80 cents for it. And so because of that, you're going to see what we're seeing now. You're going to see stuff drying up. They can't afford to even sell it to you. And then the stuff that is on the market that is a little cheaper, and by cheaper, we mean 60 cents. Even that's overpriced because a lot of that is very low price band. Paying 60 cents on the dollar for an asset that's $200,000 makes a whole lot more sense than paying 60 cents on the dollar for something that's sub 40. And that's really where we are. But that kind of thing does not sell somebody into the business. And if you're talking about reality here, there's gurus out there, and this is how they make their money, by selling people into the industry. And it's not cool to tell somebody, yeah, pretty much you're not going to make the profits that I'm displaying in my presentation, which leads to another conversation that Sabrina and I had recently with an investor. To give you a little bit of context, the question that was shot over to me was, Zarina, where's the assets? Where are the non-performing assets? And just as a caveat, I don't necessarily like playing in spaces where I'm not profitable. So right now, personally, I don't play in the NPL space because I'm not going to pay 65 cents for an asset. So they were asking, where's the inventory? I said, I don't have any right now. And it's really, it's kind of dried out and it's very expensive. So their next thought, which is not a bad thought, was, okay, well, why don't I just go up the ladder? Why don't I go raise some money and be able to buy my own pool instead of waiting to pay, astronomical prices as a retail person? What they were not prepared for was the reality of what that looked like. Sabrina, can you talk a little bit about what that conversation ended up being?
Me screaming and hollering like a crazy person. So we ended up, trying to be positive in that conversation, but in the same token,
Sabrina, have we lost you?
Uh-oh. I thought we were all kind of frozen there for a second.
No, we've lost Sabrina.
Uh-oh.
So hopefully she'll come back. But basically what happened was we tried to, we basically had an hour and a half conversation saying the same three things, three different ways. And really, this is a person, not to pick on them or anything, this is a person who was basically sold into the industry on this idea that you can get non-performing assets, modify them, get them reperforming, and then sell them in the market and, go about your day. That's fine if this were 2012, and it's not. And now for you to get an asset sub 40 at 60 cents on the dollar, work it out, pay your expenses, pay back taxes, you're not looking at very much profit. And even if you were to get it reperforming, you have to sit on it for a few months of seasoning and then sell it off. So it's the profits that will come to you because you're selling a reperforming loan at that point are still not really where the it factor is. It's a lot of work. And so what Sabrina actually suggested to this individual was, hey, buy a really cheap asset, spend a couple $1,000 on an asset and work it out, from start to finish, perform your exit strategy and things like that. And then see how much work actually goes into a non-performing asset. Once you realize how much work goes into it, it'll make you think twice about what you're paying 65 cents for. And, just thinking about things that way, understanding what you're getting into. And again, this individual hasn't bought an asset. They've been putting in bids. And even with that, I think, Joe, you mentioned earlier, when you're putting in bids and you have a pricing expectation because you're taught, hey, this is where you put bids in, you're not going to win because now the market is different. You're putting in bids at 45 cents, 50 cents, and this seller wants 60, 65.
Yeah, and everyone has to keep in mind that you make money at the bid. So if you're pricing based on UPV, you really don't understand what your profit truly is. That's why it's important to price off of your returns. And everyone has a different risk tolerance. So, if you are an individual taking it out of a self-directed IRA, basically retirement account, your risk tolerance may be lower, but and as well as your expected returns on that. But for a sustainable business model, when you have pricing that's in that 65%, 75%, and bring on investors, you really have to understand, okay, well, I only have a little bit of a margin here. Am I going to make a profit? Or am I going to have a return on this investment? And so it's extremely important to understand at the bid price where you stand on your return. It's extremely important. And they're not teaching you that in any of these guru classes. All the research we've done, it's never about the return on your investment. It's all about what pricing is, what the seller's pricing it at.
And I think that that kind of hits it right, the nail on or the hammer on the nail head, if you want to call it that, because I mean, Zarina, you had mentioned earlier that the market is flooded with these institutional funds that are sucking up all these non-performing loans.
Mm-hmm.
Well, so that's why the prices are getting driven up, is because there's so many hungry loans out there. They're willing to take just about anything to make any kind of margin whatsoever on their fund. Otherwise, they lose everything, right? So they're kind of
There's another thing I've noticed too, that people that are coming out of these classes or just learning about notes, they're spending at that 65-75% of UPB just because they want to learn about the note.
Yeah.
Okay. So that's great, and it's definitely an education process in purchasing a note. But at the same time, you want to make sure that you're not going to lose money too when you buy the note. And so a lot of these notes are being sold at that level, and it's basically doing a disservice to this market right now.
Absolutely. And in this same vein, just so people can understand, the counter argument, which is also false, is, well, that's probably just because there's a supply and demand situation going on now, and that's why hedge funds are spending so much money, because they want to win the bids and deploy their capital and make any kind of profits whatsoever, which Joe just pointed out, which is actually partially true, and we'll get into that in a second. But even with supply and demand, there's an X factor in this whole situation that people don't understand. Goldman Sachs is the number one buyer from Fannie Mae. I've done the research. I know this hands down. They're the number one buyer from Fannie Mae. Well, Goldman Sachs actually is partially responsible for why notes are so expensive. So Fannie Mae began selling loans in 2014. So we already had a market at least 4 to 5 years prior to that of buying notes at 20 cents, 30 cents. Fannie Mae says, hey, let's get into this market. Maybe there's some people where we can dump this stuff off. And they sold their first couple pools for around 50 something cents. Goldman Sachs then came in and started bidding at 60s and then 70s and then into the 80s. And now, 2019, they're selling assets at 90 cents plus for non-performing loans. One of the reasons that they're able to do that is, first of all, they don't want huge returns. Second of all, they actually get an incentive from the government. They get a credit. So Goldman Sachs got slapped by the government after they got the bailout from the government that said, you owe the American people this money, but we will give you a credit for every non-performing asset that you buy. So really, they create the problem and then they're paid in a way to fix it. So it doesn't really matter at that point to them that they're paying 90 plus cents for a non-performing asset, because they're winning either way. What that does for us on the trickle down, though, is it affects pricing. And that's why pricing has gone from 30 cents to 40 cents to 50 cents to now 60 and 65. And as Sabrina mentioned earlier, up into the 80s for non-performing assets. And what Joe was saying, Sean was saying about, people coming into the industry and willing to pay 65 cents for a non-performing asset just to get their hands on an asset is not helping the situation. It's not helping the problem of this astronomical top of the market pricing that we have. Any other comments on that, guys?
No, but I will say this. I will say that, we talked a little bit about this earlier, and there's a difference between purchasing these assets for yourself, as Sean mentioned, if you're an IRA investor, for example, or if you're establishing a business. If you're establishing a business, you've got to understand the return that you're going to make in addition to the volume that you need to bring in. And that volume that you need to bring in has to be purchased at a certain rate. And if the market isn't at that rate, then you're in trouble and you have to figure out a different strategy because it's not going to be sustainable. So for instance, when we started out, we had a minimum of 30% return that we had to make, and we were using our own capital at this point.
Mm-hmm.
And then when we bring investors in, we have to figure out, based on that 30% return, how many investors do we have to have? How much capital do we have to bring in order to make that work? And then on top of that, now you're dealing with, okay, well, we have the capital ready to go. How are we going to get those assets that are going to sustain us at 30%? You're looking at maybe 15 to 20%, as a stable consecutive level coming in, if you're lucky, and if you're going to buy volume, people say that you get discounts on volume. Well, it's true, but you have to have a huge volume to get those discounts. You're not going to get it on 5, 10, or 20 assets. You might see maybe a percentage or two lower, but it's not.
And you're lucky to see, honestly, you're lucky to see the discounts on the volume at this point. I mean, that's how bad it is. I have a client who's looking to get into some notes, and, a couple people gave me some connections, and they said, hey, we don't sell anything less than 10. They had about 200 assets to sell, and they wanted 60 cents, and all of their assets are sub 40. So I said, these are sub $40,000 unpaid balances, and you want 60 cents, and that's a bulk price. So, I mean, it's absolutely ridiculous at this point.
And then there's other people out there selling performing notes that are non-performing notes, and they're selling them in the 90s.
Which we went over.
Which we've gone over before.
We've gone over that. This is a good segue, though, into what we talked about a little bit earlier with just alternative strategies, because one of the things that I've seen, and one of the things that I'm, doing with Note Inc., especially the people who are part of my membership, is the fact that when you come into the industry and you're taught a very specific way of operating your business, and then the industry changes around you, you're kind of stuck. You don't know how to pivot. You don't know how to do something else. And that's something that the Revival Brothers really harp on, because they're in this to really create a business. And based on, what you were just saying, Joe, there's certain things that you can do individually with your own money, which is fine. But then when you want to scale up and you're taking other people's money, there's certain strategies that don't actually make sense anymore as far as the returns. So can you talk about some of the things that when the Revival Brothers came in, you guys thought, hey, we're going to be doing this. And then you got in and it wasn't so much like that.
Well, when we got in, we were thinking, okay, we're going to get into non-performing notes, and our hold time on each asset's going to be around 8 months. That's what everybody was, around us at all these conventions were kind of harping on, and we were like, really? Okay.
8 months.
Yeah.
Less than a baby, huh?
And that might be true with maybe 1 note out of 10, if you're lucky to. But on average, we're looking at anywhere from 12 to 14 months. And so now we have to take a 12 to 14 month hold time into consideration, as well as a lower return. Today we're not getting what we were getting before. We were getting 30% on our money per year as a yield. Now we're looking at maybe 15 to 20%. So now we have to ask ourselves, if we're going to bring investors in and we're going to give our investors 10 to 12%, what kind of return are we going to get, and what kind of volume do we have to do now in order to make that work? So it really becomes a volume game at this point, and whether or not you as a company can handle that volume. Do you have to hire other people? How much is that going to cost? Can you do it all on your own? What kind of technology do you have to achieve that? There's all kinds of factors that go into it, and then there's your overhead that you have to deal with. So, and marketing, of course. So, to make it work as a business is far more difficult than doing it as an individual, and doing it as an individual is difficult. So, I would say this: if the sellers are asking you for 60, 70 cents or more, make sure that you understand your return make the argument with them and let them know that, you know, based on what they're asking for, your return's so low that it wouldn't. I've had these conversations with, there was a project in Washington, and I think, did I tell you this story before? I don't remember. So this project in Washington came across our desk, and it looked really good. The value was really high. The value was in the 400s. And I think the UPB on it was somewhere around 250, and they were asking like 220 for it or something like that. So they were asking quite a bit of money to the UPB on it. But it was vacant, and it was definitely a fixer-upper. It was one we could foreclose on fairly quickly. But we dug deep into due diligence on it, and we found that there was a high-rise, low-income housing subsidized by the city, literally right across the street.
Oh.
What does that mean? Does that mean that the value of the house is going to go down? Does that mean that rent will go? Basically, rent is non-existent at that point. You can't rent that house out. Mm-hmm. So if somebody were to purchase that house and try to rent it out at some point, it just wouldn't happen. So based on that alone, you have to assume that the value is going to go down. So that $450,000 that it's worth today, after that development's done, isn't going to be $450,000. It's going to it's going to take a hit. That you know, in addition to the condition that the house was in and how much you had to put into it and all that. I mean, we were looking at, if we were lucky, maybe making 8% on it. And you know, for that kind of money going in there, especially in the state of Washington, where there's all kinds of restrictions and code violations of every kind that you can imagine. I mean, you want to really step into that and that kind of risk? No, I mean, it wasn't worth it. So we had the discussion with the seller. The seller didn't care. The seller kept arguing, oh, you know, here's the value and this and that, and this is a great neighborhood. It's an up and coming neighborhood. You know, all this development's going on around it. But what they didn't sit down to realize is, well, some of that development.
What kind of development?
Yeah, is a negative impact, not a positive impact.
Well, and that's, you touched on something that Sabrina, before her internet clunked out, spoke about, and she said that notes is not real estate. And what she means by that is a lot of sellers are telling you, this is the value of the property. This is the value of the property. The value of the property has no precedent, really. Hey, there she is, on what you're paying for the note. If you have a $10,000 note, unpaid balance, and the property is worth $1 million, that doesn't mean that you have any business going anywhere near or over that $10,000 unpaid balance. Notes is not real estate. And for somebody to try to sell you saying, hey, well, the asset is worth this, or the asset is listed, and that's why I'm not coming down off of this 65 cents or this 70-cent price tag, they're almost, I don't know if it's they're stupid or they think you're stupid. One or the other.
They're insulting your intelligence. Yeah. They are insulting your intelligence. Yeah. They're playing people for dumb, dumber, and stupid.
Right.
And you know, and there's one slickster out there. I mean, he fast talk you all day long, get your money, and then you run into other issues also. You trying to get exceptions cleared. You know, I asked him. I said, well, will it snow before you clear my exceptions? Before I get the corrective assignments? I mean, and I don't mean to, be nasty, but that's really the truth. You know, and it's almost like once you fund, you're done. And it doesn't even matter if they want to keep a relationship with you.
Well, they made their money off you at that point.
Yeah, they've already made their money, and there's no redemption per se. And, so the other thing that people need to realize is while they're selling you this glitz and glam about what the property is worth, if you complete the foreclosure, the only thing you can bid is your balance.
Absolutely.
And recoverable advances. That's it. You can't go over and above. And if your UPB balance is 100 and the property's worth 400, guess what you're going to get?
100.
You're not going to get your real estate back. You're going to get your 100 grand back. So basically, you just loaned your money to somebody for a little while with very little profit, if any.
So now that you're back, I'll catch you up on what we talked about. There were some topics specifically that you wanted to speak on. We did not talk about those, so you still have a little bit of room. But we did talk about alternative strategies a little bit with the Revival Brothers. But there was a couple topics specifically on due diligence and like curing assignments and things like that people aren't really doing. And that's also critical to what you're willing to pay for an asset. Can you speak about that a little bit?
So, it's so funny. So we just did some invoicing because it was the beginning of the month, and one of our investors was like, you charged all these success fees. I said, did you look at your invoice? Did you look at your invoice? And well, no. I said, well, look at the line item that says doc fees, recording fees. It was almost $3,000 that they were not prepared to spend on recording fees because there were several assignments that had not been recorded prior to their purchase.
Wow.
So again, something else that people don't factor in when they're buying. And all of those things I think have to be taken into consideration with your pricing.
To slow that down for some, and I don't mean to cut you off, but to slow that down for somebody who doesn't understand what does she mean? When you're buying an asset, if the previous owner of that asset and then that previous owner of the asset have not recorded their assignments and you purchase the asset, that recording is now on you. So you have to record 2 buyers back, including yours, which is probably something that you did not anticipate. And that's more money out of your pocket. So I just wanted to make that clear. And if we're talking Pennsylvania, that's a lot of money.
When we bid on projects, we actually take the worst case scenario into play. So we'll put on every bid, a $5,000 lawyer fee, which would hopefully cover that kind of issue. It would hopefully cover foreclosure if it came to that. So, be conservative with your approach and your numbers in understanding your returns, because you can really get caught. And I mean, our motto is we're gonna back the numbers down to worst case scenario. We break even. We don't want to lose money ever. So if the worst case scenario happened, we would break even. We'd be fine with that. And that's what we tell our investors as well. So we obviously try to look for the best deals possible, and we try to mitigate our risk through our due diligence, but sometimes things happen. And if the worst that can happen is you break even, I think you're walking away okay.
So here's my last question, and you guys can answer it however you feel. Actually, no. Before we get to that, one other thing that you had said, Sabrina, was, and it seems off topic, but it's actually not. You were talking about the influence politically and how that affects our industry versus, like a Republican in office versus a Democrat in office, and how that affects the way underwriting is done. Can you touch on that a little bit? And then how does that apply to the note investors down the way?
So one of the things that I've noticed being in banking for as long as I have been, and most of the time attached to mortgages, is that when there is a Republican in office, the underwriting guidelines in mortgages is very loose. We're starting to see no docs again, NINAs. No docs is no income, no assets. It's basically your mortgage is driven on your credit score. And stated income, all of these are credit-worthy loans. That is really why we are in the situation that we're in today when we saw the market crash, but it's starting to repeat again. Mm-hmm. And the other thing is that some of those same loose guidelines that happen, when a Democrat gets in office, they don't just tighten the purse strings, they cut them off. I mean, if you are, if you're not credit worthy, you're not getting a loan, and the mindset is totally different. So what is going to happen is like right now, I have a friend that's in the mortgage industry that's doing 1 day out of foreclosure with a 500 credit score as long as they have a down payment. So if we change, Democratic parties, or I'm not Democratic parties, but political parties to a Democrat, what you're going to see is those guidelines are going to tighten up again. And then people who are banking on being able to refi and just kind of been reckless and not pay their mortgage for, 60, 90 days going to 120, what you're going to find is the foreclosure boom is going to happen all over again once we transition back into a Democrat in office. And it's not even, I won't even say who's leading the House and who's leading that. It really, I say, it's the president. It is the president who's in office that I think makes a lot of those decisions that drive how lending is done and the guidelines. it's just, for me, for what I've seen, it's just been historic. And people may not want to talk about it. They may agree, they may disagree. But I think that I've been around long enough to know that that is a trend. You know, when I think about when I was working at Nova Star Mortgage, and when the underwriting guidelines started changing, like, I mean, it was almost every single day the guidelines were changing. You know, you write a loan and think it was approved, and then it would get kicked back because the underwriting guidelines had changed. And that was because we couldn't keep up with the changes that were being made due to the transition that was happening in the White House. So I just think that we also should keep that in mind.
How do you think that will affect the seller financing industry outside of the mortgage industry? I mean, let's say that a Democrat got in office. Do you think that seller financing, the single seller financer companies, the smaller companies out there, are going to be hurt?
I think they'll hurt again if we are not successful in changing the way seller financing is looked at. There's a lot of people, the reason I think that they're afraid of seller financing is because they don't understand it and they don't know. So what you don't know, you don't like.
Right.
You know, if it's foreign, we don't like it because we don't understand it. It's not that it's not good for our economy. It's not that it's not good for our neighborhoods, but a lot of people, even in politics, don't understand the benefit and the advantages of seller financing. So I think that it's really, really important that we really push hard to get some of those laws changed so they can't be overturned. So then the people who are doing seller financing, they're not affected as much when we change political parties, if we change political parties.
And I'll speak to that a little bit as well, because I like to think that I specialize in seller financing just a bit. And the truth of the matter is that most seller financing is done like one-offs. You know, they're mom and pops and they needed to sell their house. That's probably 75% of the case. It's that 25% of individuals who run firms, or they have investment companies, or, you know, they just buy a lot of land and they sell off these land tracts. What I've seen traditionally is that those kind of people, those investors, run behind regulations, meaning a regulation will drop tomorrow and they won't implement it or even know about it for like a year or plus. And so for some time, after Dodd-Frank came out, and then after the SAFE Act came out and things like that, you had to be really extremely careful with the kind of seller financing that you purchased, because a lot of it was non-compliant. And even to this day, there's probably a lot of seller financing that is not compliant. And it's just because the industry kind of lags behind new regulations. And especially if we get someone in there where regulation is changing, you know, month in, month out, that's really going to affect seller financing in a way that we probably haven't seen, depending on how much regulation is pointed towards seller financing. So that's a very good question.
So, you know, the other thing is that, you know, not going off on a tangent. So one of the other things that I think is so wrong with seller financing, I was talking to someone yesterday about a seller finance deal that they're trying to originate. And I was like, well, you know, have them complete a 1003. They were like, well, what's that? I said, that's a loan application. I mean, just like the simple things that they should know when they're originating, also devalues their loan when they try to sell it because they actually haven't originated it properly.
Mm-hmm. Yeah. And here's the thing, here's what's interesting. And this harps back to the conversation that Sabrina and I had with that investor, you know, the one who wanted to go up and buy from Fannie Mae and things like that, was, what was interesting is we both kind of came to the same conclusion. I wasn't expecting Sabrina to side with me on it, but he asked a very simple question. He said, well, where's the opportunity then? You know, we had beat him down on the call enough, I think, that he realized he wasn't going to win. And he said, where's the opportunity? And kind of got silent for a second. And I said, well, the opportunity right now is with performing loans, because there's a ton of investors, especially IRA investors, who want to see a return. They don't want to be in stocks because it's volatile. They don't want to be in other commodities and things like that for whatever reason. And you're able to supply them with performing loans and then make commissions or make a spread or make a few points. I was surprised that Sabrina agreed with me. You want to talk about that a little bit?
Not really.
She was giving me a hard time.
Because see, normally I do. Normally I go against the grain, but I was very much in agreement with Serena on that. Just because, again, removing the glitz and the glam and removing myself out of a way that I can potentially make money, I have to think about the investors because, you know, it operating in integrity and giving sound advice or giving a sound suggestion to someone to make sure that they survive. I don't want somebody to go into the space, to come into this space and, you know, make a little bit of money and then crash and burn. So again, what works best for people coming in that's new if they're looking for a return based off the pricing in the market?
Yeah. And I just said it plainly on the phone. I said, you can buy a non-performing note for 75 cents or you can buy a performing note for 75 cents. You make your choice. Make a choice.
And I was giving him an example. I think I was using a round number of $100,000 and told him what that purchase price was for a performing note that I paid $70,000 for. And he just wasn't getting it. And, you know, finally I got to screaming and hollering like some crazy lady, literally at the top of my lungs, like I was calling my kids home for a meal. Mm-hmm. Like, shut up and sit down and eat off the table because you just had a meal put in front of you. You just have to bite. And because, again, he was looking at this, he's looking at this so much like real estate. And I hate to keep saying that, but that is the biggest downfall with some of the teachings in the industry right now. They need to stop treating notes like real estate, because we also talked about owning notes without having the plunger, without having all the handyman on call. But so if that's the case, if you really are not going to be a landlord to manage a property, why is it being put in front of someone the value of the property and not really what the end result of the foreclosure or the note is going to be? What is going to be your profitable exit strategy?
Right. They dangle that foreclosure in front of everybody because they're saying that if you purchase this note and it goes to foreclosure, you're going to own it and you're going to own it with all this equity. That's basically what they're saying.
Yeah. That's and it's completely false. You can't get more than what the unpaid balance is or the payout. I mean, it's just, but again, you don't know what you don't know. You're going based on whatever this teacher or guru or whatever is telling you. And it looks great that I can buy $100,000 note on a $400,000 property. Oh my God, look at my returns. And it's not going to work that way.
So I think in one of our masterminds, Serena, I don't know if we talked about it in depth, but there was an investor there who had paid, I mean, like a pretty penny for a second mortgage in California. Property was worth like 1.4, 1.5. The first was owed like, I think like shy of 900,000. And he paid almost $200,000 for this non-performing second. And I was just like, what? But you know, he's genius at it. He's very experienced. And he probably could have made it work. Now that deal kind of went sour and south, and we won't talk about that. But there was just the people operating in the deal that didn't have integrity. Did I say that? Oh, yeah, I did. So anyways. But
there's a
but you know, again, the thing that the seller was dangling out there was the fact that the property was worth this $1.4 million. And that is just the wrong mindset to have.
Yeah. It doesn't really matter to you. It's what is the unpaid balance of this loan? Because I'm never going to get more than that. You get what you're owed, and that's what you're owed. You're not owed the property. And it's just ridiculous. And the truth of the matter is if you're taking things to foreclosure and you're getting the property back, it's because nobody wanted to bid on it. And there's a reason for that.
And then, you know, if you're in a situation where the value is really high and you know it's probably going to be bid at the foreclosure sale, you can be part of that bid. But if anything you bid above and beyond the unpaid principal balance, then all that money goes back to the borrower. So if that property is great, you choose to want it, then, all that goes back to the borrower.
Yeah.
Now that said, there is, one of the strategies that we have is looking for vacant homes and ones that we know that aren't desirable, essentially. You do take a risk in going up against some of those fix and flippers that are bidding on these homes, but at the same time, 9 times out of 10, you're going to get it back. I mean, I don't think we've ever lost one, but there are strategies out there to take the property back if there's equity. But the thing is you have to know what you're doing in order for those things to work. Otherwise, you can get screwed big time.
So to sum things up a little bit, Glitz and the Glam is not really going to tell you that at this point in time, going into third quarter 2019, we are at a very, very high peak as far as pricing is concerned on non-performing loans. Another thing is the expectations are, 60 cents to 80 cents for a non-performing loan. And that's because they're really selling you on the real estate, which again, like we just said, doesn't really influence the unpaid balance and what you're owed on the note. Something else is, really looking for alternative strategies. So if that means that you need to go out and probably learn a little bit more and learn other things that you can do in the note industry, like what the Revival Brothers do or something like that, that's probably what you have to do. So spending all of your money and all of your savings on an education that is really not relevant for the market is today is very foolish. And then finally, there is another market out there as far as performing loans. And if you're an investor trying to get started in the industry, finding individuals who want to place their money somewhere and selling them passive performing loans is probably the way that you should be starting or looking to start in the industry right now. Any other comments about that, guys?
So I know that there's a lot of people out there that have this question, and the question is where do you get those performing loans, and do they sell them one-offs or do they sell them in pools, and what's the difference between buying them in a pool and buying them as a one-off?
So for me, we don't sell performing loans in a pool. Each performing loan is sold on a pay stream and a return and a yield. That's just how we sell them here at Main Street, and it works. I mean, I just had someone. She bought 6 performing loans. Each was individually priced. They belonged to 3 different investors, and then she bought 2 loans that were non-performing. But she could look at it as it was she purchased the pool, but each loan was individually priced.
Right.
And the yield was different on each one of those loans as well.
So I get the concept of having a business and selling it to an investor, maybe a passive investor, but those that do have businesses out there that want to go out, find their own performing notes and kind of work these deals for those passive investors, what kind of suggestions do you have for them?
Hands down, especially if you're an investor who's been in the non-performing space, you probably have a very good tolerance for buying seller finance loans, which right now is a drastically underserved market. We're averaging in the note industry 80,000 plus seller finance loans a year. And obviously all of them start off performing, don't know where they are, years down the road, but it's a great supply chain. And a lot of people don't really know about it because that's not really what the gurus are teaching right now. And so again, it's about this idea of coming into the industry with one thing in mind and then getting in and finding out, oh, you know what, there's something else, there's something better. So the market is ripe on seller finance. And the cool thing about it is because so many of those notes are done by mom and pop, you really dictate the pricing over there. So if you say, hey, I'm going to pay you 75 cents, 70 cents, who are they to know they can get it for 80? They don't. And so you're really able to stabilize your returns and what you're doling out to acquire assets, because this person probably is never going to create another note in their lifetime. And so you're really able to control your portfolio in that way, and you price individually.
Mm-hmm.
So one of the things I also want to talk about with pricing on seller finance notes. So the more documentation you have, the more valuable your seller finance loan is. The less information that you have, such as tracking payments, what you accepted up front during origination, I will eat you alive when you come telling me you got a seller finance note for sale and you did not actually paper it up properly in the beginning. And then if you seem a little bit desperate, I might act like the godmother and just kind of chew you up and spit you out and like, here's what I'm gonna offer you. You either take it or leave it and go find somebody else to buy it. And I make sure that, like I can wire you cash 24, 48 hours. Either you need the money or you don't.
And that's another thing. That's another way. And a lot of people don't know to do this, but that's another way to sort of build a portfolio for yourself. If you don't have enough funds to go out and buy 25 performing loans, one way to do it is to sell partials or sell, to passive investors where you're keeping something on the back end, because you're able to buy these loans at 12, 13% yield minimum, and your passive investor might only want 6%. And so that's a way for you to also get into the industry and really get your feet wet, start a portfolio of your own and make some money. And that's really what we're out to do, is help other people in the industry make money and really just take off all the dressings and the glitz and the glam and really tell you what you need to be doing in the industry.
All right. And just for the people watching, I know that we threw a lot of percentages out there, but again, I just want to reiterate the fact that currently in today's market, where are we with non-performing notes? Where are we with performing notes on both one-offs and volume? And then also, in addition to that, we were talking about seller financing. Where are we with seller finance notes as a percentage in the market, and also partials?
So NPLs, very hard pressed to find even one-offs less than 60 cents. That unfortunately goes for bulk too. I think I saw maybe something at 55 cents, but that was on something where you're buying like 30 plus loans. So really you're looking at 60 cents minimum on even bulk non-performing loans. Performing loans, you don't necessarily purchase them based on a percentage of the unpaid balance like you do non-performing. You base them mainly on yield and what kind of yield you want to have. And so
what is that number?
12%. You start minimum on performing loans at 12%. So again, that's two different pricing strategies altogether. And a lot of people don't know how to do the conversion. A lot of people know how to, go based on unpaid balance, or unfortunately go based on a BPO price and then pick a number from there, and really don't know how to run calculations on yield for a payment stream on a performing loan. And that goes for partials too. Partials usually go to passive investors, and the numbers with passive investors is anywhere from 6 to 8%. And again, some people have trouble with that because they hang out at the RIA all day, and they don't know that people outside of the RIA don't want to have 14% yields. So again, it's just about exposure and really kind of opening up your mind to say, you know what, this isn't going to work for me. What else can I do? And really going to those avenues. So I think we're done here. I appreciate you coming back on, Sabrina, to give us a little bit of your wise crack and wisdom. Reviver Brothers, always nice to see you guys. And we have an event coming up, and then we have another major event in October coming up, correct?
Correct.
All right. So details for that is going to be out. This is LOI Events, Leaders of Integrity, saying goodbye, and don't lose your shirt.
Check us out on www.loievents.com.
That's right. Bye.
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 Bye-bye.